Depreciation is when we move an asset to an expense. For example, if we buy a big piece of equipment, we first put it in the asset account and then we systematically transfer part of that to expense. For example, everything you see on this slide we have learned before, but let's take another look at it just to warm ourselves up. So here we purchased some equipment for $100,000, and there are journal entries in place to depreciate this equipment for 3 years. We learned how to do that in a previous chapter. We also learned that accumulated depreciation is a contra asset account. That's why it has a credit balance. And the purpose of a contra account is to separate one account into two accounts so that we don't mix the debits and the credits, so that both account line items appear on the balance sheet. Some people think that it's worthwhile to preserve debits and credits separate because it might add information that is useful to some people. Also down here in red, the accounting book value is the cost minus accumulated depreciation. All that we learned before. In this short video, I'm going to teach you the amounts of depreciation for each year. There are basically 4 formulas that I did not teach you previously. Continuing with our warm-up, you see that we have been depreciating this equipment for $10,000 a year. Now, if we were planning to use this equipment for 10 years, that would be 10% per year. And after 3 years, the balance in accumulated depreciation would be $30,000. That would make the book value equal to $70,000. But the market value could be something higher or lower. Don't confuse accounting book value with market value. There are 4 ways to calculate depreciation that you should be aware of. The first depreciation method is the most common. It's called straight line depreciation. And you will be happy to know that the second method is almost exactly the same as the first method. They are very similar. By the way, straight line depreciation is so common, and it has a common abbreviation that is SLD. The next 2 methods are accelerated depreciation methods. Later in this video, I will explain what are accelerated depreciation methods. But for now, you should know that the 2 accelerated methods are declining balance and sum of the year's digits. And you might think it's good news, but we're going to skip sum of the year's digits because it is being replaced by the declining balance method. So sum of the year's digits is an old method. You probably will never see it. Now let's review the first 2 depreciation methods, straight line and units of activity. The formulas for these 2 methods are almost exactly the same. You see in red letters where they're different. In the first case, straight line, you would depreciate a truck over years. But in the second method, you would depreciate that truck per mile. Very similar. The only thing that changes is the denominator. I need to explain 2 terms in the formula. Residual value is an estimate of what you can sell an asset for when you are done with it and want to sell it. The useful life is not the total life of an asset, but it's how many years you intend to drive it before you dispose of it or sell it. Let's assume, for my example here, that we buy some equipment for $100,000. We plan to use it until it's worthless. Let's say residual value is 0, and we plan to use it for 10 years, although we could change our mind at any point in time. That means that annual depreciation in the straight line depreciation method would be $10,000 per year. This is what the accounting entries would look like for 3 years, just as an example. Now, using the units of activity method, we would depreciate this equipment, and let's say it's a truck, we would depreciate this 50 cents per mile because, see the red 200,000 miles? We plan to use this truck for 200,000 miles, and then we plan to sell it for zero. These are just textbook numbers. And so at the end of the first year, you would go out and read the odometer, and you would see that you drove the truck for 30,000 miles at a rate of 50 cents, and then you would depreciate $15,000. The next year, you would have to go out and read the odometer again, see how many miles you drove, times 50 cents a mile, and that would give you the depreciation in year 2. Let's look at this slide again. There are 4 depreciation methods. Methods 3 and 4 are accelerated. The sum of the year's digits method we are going to skip. However, you should know that it is an accelerated depreciation method. It is being replaced by the declining balance method. Now, I'm going to, before teaching you the declining balance formula, I want to talk in general about what accelerated depreciation means. Let your eyes focus in on this slide. Now, look at the column straight line depreciation. In this column, that means we bought something, say a truck, for $25,000, and we're going to depreciate it 1/5 per year. So $25,000 divided by 5 years is $5,000 per year. And it's the same amount each year, 5,000, 5,000, 5,000, etc. Now look at the chart to the right. See that blue line? That blue line represents straight line depreciation. In year 1, the depreciation is 5,000. In year 2, it is 5,000 again. It's a uniform or equal amount of depreciation every year. Contrast that with the green line. And look at my column entitled Accelerated. Now, I just invented these numbers. I just pulled them out of my head. They're not actual true numbers, but you can see the pattern. It's very large in year 1, and it is descending as you go. More in the early years, less in the later years. So those aren't real numbers, but I'm going to show you the formula next. Now, why do we have these 2 choices? Well, because some people say that when you buy an asset, they use it mostly in the early years and less as time goes along. And they make that argument, and other people, because of tradition, they like the straight line method. And so accountants are free to choose either method. I'm going to ask you a series of questions to help you appreciate why an accountant might choose or prefer one method over the other. So look at year 1. Notice that the straight line depreciation in that year would be 5,000 and the accelerated depreciation would be 10,000. Which is lower? The answer is straight line. Straight line gives you lower expenses in year 1. The next question is, in year 1, which method gives higher net income? Well, the answer is straight line, because the method that gives you the lower expense will give you the higher net income. Looking again at year 1, which method makes you pay higher income taxes? Well, the one with the lower expense gives you higher net income and therefore higher taxes. Let's ask those same questions for year 5. Which method gives lower expenses? The answer is accelerated. In year 5, which method gives you higher net income? Well, the one with the lower expense will give you higher net income, and that would be the accelerated method in year 5. In year 5, which method makes you pay higher income taxes? Well, the one with the lower expenses gives you higher net income and therefore higher taxes. So in summary, over the life of an asset, the total amount of depreciation using straight line or accelerated will be the same. The question is, do you want to pay the taxes now or later? Some people want to maximize income today, and pay higher taxes, to qualify for a lower interest rate loan or issue new shares of stock at a higher price. But other people simply want to postpone their taxes to later years and invest the money in the meantime. Accountants may choose either method. Okay, here is the formula to calculate declining balance. It's 1 divided by the useful life. And remember, I told you what useful life is. It's the number of years that we intend to use the asset before selling it. Doesn't mean the total life. And then we're going to multiply by 2. Now, there are textbooks, intermediate books, other books that will teach you that you could also multiply by 1.75 or 1.5. But most of the time, people choose the number 2 right there, and they call this double declining balance. Okay, let's continue. The cost minus accumulated depreciation. That's the formula. Now let's look at these red numbers, because that's where we have to think. Everything else about these formulas is really simple. But in the first year, when we go to depreciate, there is a zero balance existing in the accumulated depreciation account. And then in the second year, we have to find the balance. The balance is the depreciation from the previous year. So, and I want you to be able to do 3 years of this. So in the third year, when you do the depreciation calculation for the third year, what will the balance in accumulated depreciation be? Well, it would be the sum of all the previous depreciation taken. So it would be the sum of 20,000 plus 16,000, or 36. All right, let's make it a little harder. Let's say instead of buying this asset on January 1, which is probably not typical, we buy it on June 1. And so you see in the first row, the first formula, the first calculation, we calculate the annual amount of depreciation, and then we have to multiply by 7/12, because from June 1 till the end of December, there are 7 months that have passed. And so we're going to take 7/12 of the first year of depreciation. Take a look at that.